Hi everyone, my name is Edwin Lim. In this video, we will cover topic 8 and we will continue to look at accounting for inventory. In the previous topic, we assumed that inventory cost is constant. However, in real life, inventory costs always fluctuate. We have to rely on cost flow assumptions such as FIFO, LIFO, and weighted average to account for inventory when the inventory costs fluctuate. The selection of inventory cost flow assumptions will affect our cost of goods sold, net profit, and closing inventory. We will wrap up the inventory topic with the lower of cost and net realizable value. Because when the value of inventory declines, we are required by accounting standards to write down the inventory value to its net market selling price. Before going through today's topic, let's have a look at revision question or case study 7. Discuss or illustrate how the directors of Dick Smith manipulated profits through inventory purchase strategy and unacceptable accounting treatment of inventory. In this case, Dick Smith excessively purchased products from its suppliers to obtain rebates. For example, in 2014, it has $70 million of rebates, and this figure is huge considering that the 2014 net profit after tax is only $42 million. And Dick Smith did not follow accounting standards when dealing with rebates. Accounting standards state that companies cannot consider rebates as cost of purchase or cost of inventory. However, Dick Smith recorded these rebates as a reduction in the cost of sales. This will lead to higher profit in the month when the rebates were negotiated. And worse, they even recorded the rebates before the sale of the stock and before the receipt of the rebates. In the next question, please outline the implications of the opportunistic inventory purchase strategy. First, with the purchase of obsolete stocks, Dick Smith will need to write down the inventory according to the lower of cost and market price rule, which we will cover in this topic. Next, it will lead to fire sales of obsolete inventory. Outdated inventories can only be sold out at very low price, and this can cause cash flow risk and lead to business failure. Lower profit following the inventory write-down in the future period can lead to a decline in share price. Lower profitability, poorer cash flow performance, lower asset base, and increased leverage ratio or debt to asset ratio suggest a potential breach of debt covenants, which can lead to very costly renegotiation. Banks may ask for immediate repayment, liquidate the collateral, or charge higher interest rates. Okay, let's go through today's topic. Please go through the learning objectives. During the year, we make several purchases of inventory. The costs of inventory are not constant. Inventory costs fluctuate because of various reasons, which can include inflation that makes inventory more expensive. It can also include reasons like exchange rates, because the appreciation and depreciation of the currency will decrease or increase the cost of inventory. And it can also be driven by purchasing strategy. For example, if the company buys inventories in bulk, they are entitled to more discounts. That can reduce the cost of inventory. The fluctuation in inventory costs create some challenges in financial reporting. For example, what will be the cost of goods sold? And we know that cost of goods sold will affect our gross profit and net profit. It would also lead us to question what is the closing inventory, which will ultimately affect the asset value. In today's seminar, we are going to look at the cost flow of inventory. This example shows what are likely to happen in real life. When we run a business, it is unlikely that we purchase inventories at one fixed price. we will purchase inventories at different prices. For example, the opening inventory is at $8 per unit. But for the subsequent purchases, the unit price ranges from time to time. From this example, we learned a lesson. The unit costs do not remain constant. This creates an issue. Because inventories are purchased at different costs, how do we determine the cost of goods sold and closing inventory? And at what cost? To calculate the cost of goods sold and closing inventory, we need to apply cost flow assumptions. Last week, we mentioned about a term, cost of goods available for sale. And how do we calculate cost of goods available for sale? So cost of goods available for sale, COGAS, equals to opening inventory plus purchases. And what cost flow assumptions would do is to split COGAS into cost of goods sold and closing inventory. So using this formula, so COGAS basically equals to cost of goods sold plus closing inventory. And the way we determine cost of goods sold will affect net profit because cost of goods sold is expense. And we will use revenue minus expense to calculate the net profit. The closing inventory will affect the total asset we report on the balance sheet. There are several cost flow assumptions including specific identification, first in first out, namely FIFO, weighted average, and last in first out, known as LIFO. Note that in Australia, firms can only choose from one of the first three cost flow assumptions, meaning companies can use specific identification, first in first out, and weighted average. But companies in Australia cannot use LIFO, cannot use last in first out, because LIFO, as later on you will see, it will result in lower closing inventory, which does not reflect the current value of inventory, especially during the inflationary period. And it also results in lower profit, so company has a chance to minimize and avoid tax. LIFO is, however, permitted in the United States. The above cost flow assumptions can be applied to both perpetual and periodic methods that we covered in the previous topic. Now, let's look at specific identification. This method exactly tracks every item through serial number when it is sold. So it matches the physical flow of inventory. This method will result in accurate cost of goods sold and closing inventory. Because under specific identification, we track every sold item and record their exact cost of goods sold, it can only be used with the perpetual method. This method cannot be used in conjunction with the periodic method. Although it can be costly and time-consuming, the limitation can be overcome by technology. For example, we can utilize scanner and barcodes. This method is more suitable for small volume, high value inventories such as car, house, and jewelry, because we cannot afford to lose these expensive inventories. The second assumption is first in, first out. FIFO assumes that the earliest purchased units are first sold, leaving latest purchased units as closing inventory. It therefore better approximates the physical flow of inventory compared to weighted average and LIFO. And this assumption is suitable for perishable items such as food or items that are subject to obsolescence such as technology, which will become easily outdated. In the period of rising prices, meaning when things become more expensive, this assumption will lead to lower cost of goods sold. Because cost of goods sold are based on earlier purchase at cheaper costs. And lower cost of goods sold will lead to higher profit. And because closing inventory are the latest purchase inventory, they have higher value and they more reflect the current value of the inventory. And this method can be used with both perpetual and periodic method. And closing inventory reported on the balance sheet because they are based on the latest purchase inventory. They have higher value and they better reflect the current value of the inventory. The third assumption is last in, first out. LIFO assumes that the latest purchase units are sold first, leaving the earliest purchase units as closing inventory. And this assumption does not match the physical flow of inventory, therefore it is rarely used. This assumption is suitable for inventory that has no use-by date, for example metals and chemicals. And we can also use this assumption with both perpetual and periodic methods. In a period of rising prices, meaning when things become more expensive, this assumption will lead to higher cost of goods sold because cost of goods sold are based on the latest purchase inventory, and we purchase those inventory at a higher cost, therefore higher cost of goods sold. And higher cost of goods sold can lead to lower profit and therefore greater tax savings. And because earliest inventory purchased at lower cost will be the closing inventory, this assumption will give us lower closing inventory. And therefore, the closing inventory value under the LIFO cost flow assumptions is not so useful because it is outdated and it does not reflect the current value of inventory. So because of all these reasons, LIFO is actually not permitted under IFRS and in Australia. However, LIFO is permitted in the US. The fourth assumption is weighted average. Under this method, we will average the unit cost of the inventory, and this method does not match with physical flow. The calculation for weighted average depends on whether we use a perpetual or periodic method. If we use a periodic method, weighted average is calculated as total cost of goods available for sale, and we have actually mentioned cost of goods available for sale equals to opening inventory plus purchase, COGS, and we divide it with total number units available for sale for a period. On the other hand, if we use a perpetual method, we need to recalculate the average price after each purchase, and we will look at some examples later. So this assumption is simple and it reduces the chances for manipulation because we average out the inventory cost for a particular period, and it can be used for both perpetual and periodic methods as well. And the weighted average method is suitable for homogeneous or identical inventory that has unstable price, for example bricks, sand, and so on. Using the following illustrative example, we will demonstrate how to account for inventory using FIFO, LIFO, and weighted average. In this example, we start with 1,500 units of inventory and the unit cost is $8. We then purchase 10,000 units at $13 each and 19,000 units at $10 each. We then sell 25,000 units. Following this, we make another 3 purchases at 3 different unit costs, $12, $15, and $13 respectively. We then sell 31,000 units. In this case, the total units available for sale is 59,500, which is opening balance 1,500 units plus all the purchase. On the other hand, the total units sold are $56,000, which is 25K plus 31K. And our stock take reveals that we have 3,500 units on hand, meaning we actually don't have any stock gain or stock loss. So in this example, we don't have stock gain or stock loss, because the stock date actually matches the recording balance of inventory. So let's calculate the cost of goods sold and closing inventory under each method. Let's begin with first in, first out under the perpetual method. Under the perpetual method, because we continuously track costs of goods sold, we must prepare a stock card. And it is important that you learn how to fill in the stock card. Here we have the in column, which represents purchase, and we have the out column, which represents cost of goods sold, and the balance column, which can be used to determine the running balance of inventory and closing inventory. And we must record the transactions, we must fill in the stock card according to the proper date order. And please note that in the stock card, we only record the cost of inventory exclusive of GST. So please do not include GST when you prepare the stock card. Otherwise, all the figures will be wrong. And this will have implications on your journal entry as well. So please do not record GST when you prepare the stock card. And note that when we prepare the stock card, we record all at cost. We do not use selling price. So please do not use selling price when you prepare the stock card. So at 1st July, we begin with 1,500 units at $8 each. So the total opening inventory balance is $12,000. Then on 22 August, we purchased 10,000 units at $13 each. And on 19 October, we purchased 19,000 units at $10 each. So this will give us 3 lines for the running balance. Then on 30th November, 25,000 units are sold. Because we are using first in, first out, the earliest inventory must be sold out first. So in the cost of goods sold column, or in the middle column, we will put 1,500 units at $8 each, 10,000 units at $13 each, and the remaining 13,500 units at $10 each. This will leave us 5,500 units at $10 each as closing inventory, or the running balance of inventory. Then on 28th of January, March 12th, and 8th of June, we make another 3 purchases with 8,000 units at $12 each, 15,000 units at $15 each, and 6,000 units at $13 each. So this will leave us with 4 lines of running balance for the inventory. Then on 20th June, we sell 31,000 units. So in the out column, in the middle column, we get rid of the first 3 lines of existing balance. So namely 5,500 units at $10 each, 8,000 units at $12 each, and 15,000 units at $15 each. The remaining 2,500 units at $12 each. At $13 each. So this will leave us 3,500 units at $13 each. So if you look at the middle column, we can sum up the figures and obtain the total cost of goods sold. So the total cost of goods sold is 685.5K. However, we will use the final row balance directly as the closing inventory. So the closing inventory in this case is 45.5K. And what happens if you use the periodic method? Under the periodic method, for FIFO, there are 3 steps involved. First, we calculate cost of goods available for sale, which equals to opening inventory plus purchase. And opening inventory is 1,500 units at $8 each, and purchases for the period is 58,000 units at various prices, and the total amount for the purchase in dollar terms is 719. And how do you get 719? So just go back to the previous slide and sum up the figure in the in column, in the purchase column. So this will give you 719. That is the total purchase for the period. So this will give us COGAS, cost of goods available for sale, 731. Second, we will calculate the closing inventory based on physical stock date or count. Recall that under the periodic method, the stock count, the physical count, will give us the closing inventory figure, 3,500 units at the most recent purchase price. The most recent purchase price in this case is $13. So that will give us 45.5K. And we use the most recent purchase price to calculate closing inventory because under FIFO, we assume that the earliest purchase inventory are already sold out, leaving the most recent purchase inventory in the warehouse. Third, we calculate the cost of goods sold, which equals to COGAS, 731K, minus closing inventory, 45.5K. That will give us 685.5K. So you observe that if we use the first in, first out cost flow assumptions, it will actually give us the same cost of goods sold and the same closing inventory, regardless of whether we use the periodic method or the perpetual method as we did in the previous slide. So only for the first in, first out method. Alright, now let's look at last in, first out, LIFO, under the perpetual method. Under the perpetual method, because we continuously track cost of goods sold, we must prepare a stock card. Alright, and I need to remind you, when we prepare the stock card, please record it according to the proper date order. And please note that in the stock card, we only record cost of inventory net of GST, meaning you do not include the GST. And we do not use selling price of inventory when we prepare the stock card. So, at 1st July, we begin with 1,500 units at $8 each, and the total opening inventory balance is the same, $12,000. On 22nd August, we purchased 10,000 units at $13 each, and on 19th October, we purchased 19,000 units at $10 each. So this gives us 3 lines for running balance. Then, on 30th November, 25,000 units are sold. Because it is last in, first out, the latest inventory are sold out first. So in the cost of goods sold column, in the middle column, we put 19,000 units at $10 each, and the remaining 6,000 units at $13 each. This will leave us with 1,500 units at $8 each and 4,500 units at $13 each. And the earliest purchase inventory will become our running balance. Then, on 28th January, 12th of March and 8th of June, we make another 3 purchases with 8,000 units at $12 each, 15,000 units at $15 each, and 6,000 units at $13 each. This will leave us with 5 lines of running balance for the inventory. On 20th June, we sell 31,000 units. So in the out column, we first get rid of the first 3 lines of the existing balance, namely 6,000 units at $13 each, 15,000 units at $15 each, 8,000 units at $12 each, and the remaining 2,000 units at $13 each. This leaves us with 1,500 units at $8 each and 2,000 units at $13 each. If we look at the middle column, we will sum up the figures to obtain the cost of goods sold. So the cost of goods sold in this case is 693K. And we will use the final column for the closing inventory balance, so which is 38K, 12K plus 26K. And what happens if we use the periodic method? Under the periodic method for LIFO, there are also 3 steps involved. First of all, let's calculate COGS, cost of goods available for sale, which is opening inventory plus purchase. And in this case, it's going to be the same, 731K. So opening inventory is 12K and purchases is 719K. Then we minus closing inventory per stock take. Under the periodic method, the stock count gives us the closing inventory figure. So 3,500 units at the earliest purchase price. So this will be 1,500 units multiplied with $8 and 2,000 units multiplied with $13. That will give us 38K. And we use the earliest purchase price to calculate closing inventory because under LIFO, we assume that the latest purchase inventory are already sold out, leaving the earliest purchase inventory in the warehouse. And third, we calculate cost of goods sold. So COGS minus closing inventory, that will give you 693K, which is the same as the total figure under the cost of goods sold column that we calculated just now when we used the perpetual method. So how about weighted average? For weighted average under the periodic method, we will determine one standard unit cost, so which is calculated as COGS, which means opening inventory plus purchase, divided by total units available for sale. So COGS in this case is 731K, which is the opening balance 12K plus total purchase 719K, and the total number of units available for sale is 1,500 opening units plus 58K units purchased, which equals to 59,500 units. So we divide 731K by 59.5K units. So per unit cost is $12.2857. After we calculate this standard unit cost, we multiply with the quantity sold, which is $56,000 units, to derive the cost of goods sold of 688K. And we multiply the unit cost with physical count quantity, which is 3,500 units, to get the closing inventory of 43K. If we use weighted average under the perpetual method, we will call it as moving weighted average because we need to recalculate the average unit cost after each purchase. And again, under the perpetual method, because we continuously track the cost of goods sold, we must prepare a stock card. And remember to record it according to the proper date order, and we do not include GST when we prepare the stock card. So no GST. In the stock card, and please do not use the selling price when you prepare the stock card. So on 1st July, we begin with 1,500 units at $8 each. The total opening inventory balance is 12K. On 22nd August, we purchased 10,000 units at $13 each. Every time we make a new purchase, we will recalculate the unit cost. So we use the total dollar value for the stocks on hand, which is 142K. And how do you get 142K? Simply is 12K plus 130K. So you get 142K. You divide by the total quantity of stocks on hand, which is 11,500. And how do you get 11,500? 1.5K plus 10K. So when you divide the two amount, 142K divided by 11.5K, you get the updated unit cost. So the unit cost here is $12.3478. On 19th of October, we purchased another 19,000 units at $10 each. So again, we have to recalculate the unit cost. So we sum up the total 332K and we have 30.5K units on hand. So the updated unit cost will be $10.8852. Then on 30th November, 25,000 units are sold. When we record the cost of goods sold, we need to rely on the most recent average unit cost, which is $10.8852 here. So this will give us the cost of goods sold of 272,131.15. We will also calculate the running balance, 5,500 units at this most recent unit cost, $10.8852. Then on 28 January, March 12th and 8th of June, we make another 3 purchases with 8,000 units at $12 each and 15,000 units at $15 each and 6,000 units at $13 each respectively. So we keep recalculating the unit cost at each date, and which changes from, you find that the unit cost actually changes from 10.8852 to 11.5458 to 13.3638 and finally to 13.3005. Then on 20th of June, we actually sell 31,000 units. So in the out column, we use 31,000 units multiplied with 13.3005, which is the most recent unit cost, to calculate the cost of goods sold. And this will leave us with 3,500 units at $13.3005 for the closing inventory. So in this case, our closing inventory is 46,552 and our cost of goods sold is 684,448 when you sum up the middle column figures. So after calculating cost of goods sold and inventory under several cost flow assumptions and under the perpetual and periodic methods, we can make a comparison. You find that sales revenue will be unaffected by the cost flow assumption. So the sales revenue will be the same regardless of whether you are using the perpetual method or periodic method, or regardless of the cost flow assumptions that you use. But you find that cost of goods sold, gross profit, net profit, and your closing inventory will vary depending on whether you're using the perpetual method or periodic method, and depending on whether you're using the FIFO, LIFO, or weighted average assumptions. So just a recap in terms of what we have covered so far. In the periods of rising prices, meaning when things become more expensive, FIFO gives the highest closing inventory, so it reflects the current value of inventory, and it has the highest gross profit and net profit but the lowest cost of goods sold. On the other hand, LIFO will have the lowest closing inventory, which fails to reflect the current value of the inventory. It also has the lowest gross profit and net profit with potential tax savings, and finally it has the highest cost of goods sold. And the other cost flow assumptions will usually give you the figures that fall somewhere between FIFO and LIFO. Alright, student task. In this case, the company has opening balance of inventory, 300 tables at $200 each. So please do not forget about the opening inventory. And the $200 here is exclusive of GST. Then the purchase and sale of inventory with GST inclusive amount are presented below. At 30th June, the stock take shows 448 tables on hand. So there are 4 parts to this question. The first 2 parts relate to FIFO. So part A and part B, we are required to do FIFO. And for part C and part D, we will use moving weighted average cost flow assumption. So now let's look at part A. Part A requires to record the entry using the periodic method, and the cost flow assumption is FIFO. Under the periodic method, we do not need to maintain a continuous record of cost of goods sold and inventory, so there is no need to do a stock card. We can directly perform the journal entry. So 1st of June, you purchased 200 tables at $264 GST inclusive each. So recall that under the periodic method, we record inventory in the purchase account, which is an expense account. We do not record the purchase in the inventory account. So you credit accounts payable 52.8K, and how do you get this? So you take 200 multiplied by 264. This is GST inclusive amount. Then you debit purchase 48K, which is 10 over 11 net of GST, and you debit GST clearing 1 over 11, 4.8K. You debit GST clearing because you have GST recoverable for purchase of goods. Then, on 9th of June, you sold 350 tables at $440 each, inclusive of GST. So here we debit accounts receivable 154K. And how do you get 154K? You take 350 multiplied by 440. So this is GST inclusive amount. Then you credit GST clearing 1 over 11. When you credit GST clearing, it means that you have GST payable because you collect tax from the consumers, from your clients, and this tax is payable to the ATO. So credit GST clearing 14K, and you credit sales revenue net of GST 10 over 11, 140K. Then on 10th of June, you purchase 400 tables at $198 GST inclusive amount. So you credit accounts payable 79.2K, which is 400 tables multiplied by 198 each, GST inclusive amount, and you debit purchase 10 over 11 net of GST, 72K, and you debit GST clearing 1 over 11 of 7.2K, following the same logics. Then on 14th of June, you sold 200 tables at $374 GST inclusive each. So here we debit accounts receivable 200 multiplied by 734, so you get 74.8, and this is GST inclusive amount. Then you credit GST clearing 1 over 11, 6.8K, and you credit sales revenue 68K, which is 10 over 11. On 20th June, you sold 150 tables at $484 GST inclusive each. So here you debit accounts receivable 72.6K, which is calculated as 150 multiplied by 484 GST inclusive. Then you credit GST clearing 1 over 11, 6.6K. You credit sales revenue 66K, 10 over 11. Then on 28 June, you purchase 250 tables at $330 GST inclusive each. So you credit accounts payable 82.5K, which is 250 multiplied by 330. GST inclusive, and you debit purchases 75k, which is 10 over 11, and you debit GST clearing 1 over 11, 7.5k. And here we need to perform the closing entries and set up the closing inventory under the periodic method. So first of all, we close the opening inventory with a credit entry, which is 60k. That is calculated as 300 units times $20. Then we credit purchase expense account, which is 195k. We made 3 purchases for this period, so 48 plus 72 plus 75k, you get 195k. Then we debit P&L summary 255k. Then we debit sales 274k, and we made 3 sales for the period, 140 plus 68 plus 66k, that gives you 274k. We also debit closing inventory. A stock take at 30th June revealed that we have 448 tables on hand. So we will use this figure directly as closing inventory when we use the periodic method. So 448 units closing inventory under FIFO will be the latest purchase units. So 250 units from the latest purchase at $300 each, exclusive of GST, because we always record inventory exclusive of GST. And the remaining 198 units from the second latest purchase at $180 each, exclusive of GST. So this will give us 110,640. So we credit P&L summary with a total 386,640. And we do not need to close P&L summary to retain profits for this question because we do not know other operating expenses. So just keep this question simple and easy. Okay, let's look at part B of the question. This part requires an extract of income statement under the periodic method. So we start with sales revenue 274k minus cost of goods sold. And we know that cost of goods sold is derived under the periodic method using the following formula. So we start with opening inventory 60k plus purchase 195k minus closing inventory 110,640. This gives us the cost of goods sold 144,360. And sales revenue minus cost of goods sold, that will give us the difference 129,640 as gross profit. Alright, let's look at part C of the question, which requires us to prepare a stock card using the moving weighted average assumption under the perpetual method. And I have to remind you again, we must record this according to the proper date order. And please note that in the stock card, we record the cost of inventory at cost, exclusive of GST. So please do not include GST. Please do not use the selling price when you prepare the stock card. Otherwise, everything will be wrong. Okay, at 1st of June, we begin with 300 units at $200 each, exclusive of GST. So the total opening inventory balance is 60k. On the 1st of June, we also purchased 200 units at $240 each, exclusive of GST. So every time when we make a new purchase, we have to recalculate the unit cost. So we use the total dollar value for stocks on hand, which is 108k. So 60k plus 48k. 68k plus 48k, you get 108. And divide by the total quantity of stocks on hand, which is 500. So 300 plus 200. So when you divide 108k by 500, the unit cost is 216. Then, on 9th of June, 350 units are sold at the most recent average unit cost, which is 216. And we will also calculate the balance 150 units with this most recent unit cost at 216. On 10th of June, we purchased 400 units at $180 each exclusive of GST. So every time when we made a new purchase, we will recalculate the unit cost, and the updated unit cost is 189.82, which is 104.4 divided by 550. On 14 June, we sell 200 units at the most recent unit cost 189.82, leaving 350 units which are also valued at 189.82. On 20th June, we sell another 150 units also at the most recent unit cost, so 189.82, leaving 200 units also valued at 189.82. On 28 June, we purchased 250 units at $300 each, not including GST. So again, every time when we make a new purchase, we have to recalculate the unit cost, and the updated unit cost is 251.03, which is 112,964 divided by 450. And note that we only have 448 units on hand revealed by the stock take, but our accounting records show that we actually have 450 units on hand, so which is calculated as 300. So if we take opening balance 300 plus 200 plus 400 and plus 250 minus 350 minus 200 and minus 150, you find that our record shows that we are supposed to have 450 units on hand, but stock take tells us that we only have 448 units on hand. So in other words, 2 units are lost. It could have been stolen by one of the employees. So in this case, we need to also account for stock loss. So to account for the loss of the 2 units, in the out column, we use 2 units multiplied by the most recent unit cost, 251.03. So that gives us the stock loss total of 502.06. And our closing balance will be based on 448 units at 251.03 each. That gives us 112,461.4 as the closing inventory. And we sum up the middle column figure, that will give us 142,539.1 for both cost of goods sold and stock loss. And of course, the cost of goods sold in this case will be 142,037 based on the first 3 figures. So the first 3 figures are for stock loss. The final figure is actually the first 3 figures are for cost of goods sold, and the final figure is for stock loss. So the cost of goods sold in this case is 142,037. So 142,037 cost of goods sold plus 502.06, that will give you 142,539. Alright, let's do the entry under the perpetual method. So on 1st of June, we purchased 200 tables at 264 GST inclusive each. So under the perpetual method, we record inventory in the inventory account. So we debit inventory 48K, which is 10 over 11 net of GST. And we debit GST clearing 4.8K, 1 over 11. And we credit accounts payable 52.8K with GST inclusive amount. So the 52.8k is calculated as 200 times 264, and inventory is 10 over 11, GST clearing is 1 over 11. Then on 9th of June, we sold 350 tables at $440 GST inclusive each. So debit accounts receivable 350 multiplied by 440, that gives us 154k inclusive of GST. Then we credit GST clearing 14k, which is 1 over 11. And we credit sales revenue 140k, which is 10 over 11. And because we keep continuous records of cost of goods sold under the perpetual method, we need to also record our cost of goods sold. So debit cost of goods sold 75.6k, credit inventory 75.6k. And how do we get our cost of goods sold? So refer to the stock card that we prepared earlier. So the cost of goods sold on 9th of June is 75.6k. Then on 10th of June, we purchased another 400 tables at $198 GST inclusive each. So we credit accounts payable 79.2k, which is 400 times 198 inclusive of GST. And then we debit inventory 72k, 10 over 11. And debit GST clearing 7.2k, 1 over 11. On 14th of June, we sold 200 tables at $374 GST inclusive each. So here we debit accounts receivable 74.8k, which is calculated as 200 multiplied by 74 GST inclusive. And credit GST clearing 6.8k, which is 1 over 11, and credit sales revenue 68k, 10 over 11. And we have to also continuously record cost of goods sold. So debit cost of goods sold, credit inventory 37964. And how do you get this figure? Please refer to the stock card. Then on 30th of June, we sold 150 tables at $484 GST inclusive each. So we debit accounts receivable 72.6k, so 150 multiplied by 484 GST inclusive amount, and then we debit GST clearing 1 over 11, we credit GST clearing 1 over 11, and we credit sales revenue 10 over 11, 66k. And we have to also continuously record cost of goods sold, debit cost of goods sold, credit inventory 28473. And again, this figure is from the stock card. On 28th June, we purchased 250 tables at $330 GST inclusive each. So we credit accounts payable 82.5k, so which is 250 multiplied by 330 GST inclusive amount, and you debit inventory 10 over 11, 75k, and debit GST clearing 7.5k, 1 over 11. And finally, we have to also record the stock loss, because as mentioned, our record shows that we're supposed to have 450 units on hand, but the stock take tells us that we only have 448 units in the warehouse. So to account for the 2 units loss, we debit inventory shortage expense, credit inventory 502.06. So please refer to stock card for this figure. And finally, let's have a look at part D of the question. And this part requires us to prepare an extract of the income statement under the perpetual method. So we start with sales revenue 274, K minus cost of goods sold 142037 as identified earlier, and the gross profit is 131963 minus inventory shortage expense 502.06. So the adjusted gross profit is 131460.9. So this is due to the rounding error. Okay, so please do not worry about the rounding error here, as the rounding error is just very minute. Okay, finally, we ask a question: do we need to compare the book value of our inventory with the market value? The answer is yes, because according to IES2 or EESB 102, we need to record inventory at the lower of cost and net realizable value. And net realizable value is also called net market value, and it is the estimated market selling price minus estimated direct selling or completion costs. Therefore, this rule requires subjective estimates and professional judgment, because the selling price and the cost of sale or the cost of completion are estimated costs. And the market value of inventory can be lower than the cost of inventory because of several factors, such as obsolescence, meaning some of the items will become out of fashion. It may be due to damage, and also reduced demand because some products may only be seasonal. So we apply this rule because of accounting conservatism. Accounting conservatism means it is not fine to overstate your asset. So when asset value has declined, we must write down immediately to net realizable value and recognize the write down as a loss, which is a form of expense. So we do the following entry: debit inventory write down expense, credit inventory, and we need to assess this rule on an item by item basis, not by inventory classification, not by industry, not by geographical segment, because in reality, the business has more than one type of inventory, and the market price for every inventory will be different. So we need to look at each specific type of inventory separately. So is the LCM rule good or bad? The LCM rule overcomes the backward-looking limitation of historical cost. So we know that historical cost is backward-looking. It loses relevance when time passes because historical cost ignores inflation. An NRV rule helps us to reflect the current value of inventory, so accounting information is more relevant. And the rule also reinforces the matching principle, because we recognize expense incurred and revenue incurred in the same period, so periodic profit is more useful for decision making. And we should not overstate inventory amount greater than the net market value if the selling price of the inventory has declined, or if the inventory is damaged, or if the inventory has become outdated. So by using the LCM rule, we more faithfully reflect the value of inventory. However, if NRV is greater than cost, we cannot write up inventory value. So this accounting rule has been criticized because it is not consistent and it is too conservative. It is okay to write down the inventory value, but it is not okay to write up the inventory value, which is biased, conservative, and inconsistent. And NRV also requires subjective judgment, which is prone to error and manipulation. For example, we have to estimate selling price and selling cost when we calculate net realizable value. Okay, let's look at one example. In this example, we have 4 types of inventory. The cost and market price for each type of inventory are given, and we are required to assess the inventory one by one. So for item 675, the market price is lower. So we take the total 225. For item 732, the cost is lower, so we take the total 400 from the cost price. And for item 957, the market price is lower, so we pick the total 450. And for item 977, the cost is lower, so we pick the total $80. So the total for our lower of cost and net realizable value, so the total for LCM rule is 1155, and we need to compare 1155 with 1555, which is the total cost. And in this case, we are required to write down the total cost to lower of cost on net realizable value, which is 1155. So to write down the inventory, we would debit inventory write down expense and credit inventory $400. Another student task. In this case, the company sells 4 types of guitars, so let's calculate the total cost first. The total cost, to calculate total cost, we would take the quantity and multiply by the cost per unit. So 10 times 343.2, 20 times 284.5, 30 times 588.4, and 40 times 1888. That gives us the total cost of 102,326. Then we perform the lower of cost and net realizable value for G1. For G1, we pick the cost because it is the lower, so 10 times 343.2. For G2, we'll pick 276.15, the market value, because it is the lowest, so 20 times 276.15. For G3, the cost is lower, so 30 times 588.4. Oh, sorry. For G3, the market price is lower, the NRV is lower, so 30 times 564.3. And for G4, again, the market price is lower, so 40 times 1456.76. So that will give us our lower of cost and net realizable value total 84154.4, and we need to write down the inventory from 102,326 to 84,154.4. So we debit inventory shortage expense and we credit inventory with the differential amount, which is 18171.6. So that's it for this topic. Please attempt revision question or case study 8, and we will discuss at the start of the next topic.